Assalamualaikum everyone. We go now to part 7 about the pitfalls of bank leverage funding. We know by now that Islamic bank have been adopting this leverage funding system where bank uses leverage money to make loan for Islamic bank to make murabaha, and even though this leverage money is not a loan per se, or it is not a leverage interest-bearing leverage money for Islamic banking, but when the Islamic bank label the funding or the sources of funding as deposit, it automatically implies that the bank is using borrowed funds or leverage money to make their murabaha or to make their tawarruk. So we need to understand this very well because the use of deposit fund or leverage money to make murabaha or to facilitate Islamic banking transaction will eventually make the Islamic banking business converging into the conventional riba system. And we are here to try put some effort in order to find remedies and to rectify this problem, because if there's nothing done, then eventually the Islamic banking system will reflect or will essentially become united with conventional banking, and that will be a tragedy for the Muslim Ummah. So when the Islamic bank uses leverage money or deposit fund to make murabaha, that would be a very, very impossible task, because if the murabaha is the real murabaha, meaning that if the murabaha is a real sale or it is a true sale, which is in Islamic banking, it can be described as one of those products like the murabaha purchase order, MPO. This is a real sale or real or true sale. Then we will see that it will be tough for the Islamic bank to offer the MPO funded by the leverage fund or leverage money, because this MPO will contain what we call business risk, right? So all of this contract under the purview of al-bay', such as true sale, true leasing, mudarabah, musyarakah, istisna, and salam, they are by default very risky because the transaction is exposed to market volatility. So it is not a loan where the outcome of the contract is determined by the agreement or terms and condition of the contract, but the outcome of the al-bay' is influenced by the forces of demand and supply. So there is no way that we can know the outcome of the al-bay', whether the al-bay' is making losses or making profit. That will be determined by the market movement and not by way of contracts, as we saw in the ribawi system. So in the Islamic bank, they are unable to apply al-bay' as the business risk in al-bay' will put stress on banking capital. So as we see earlier, that when the bank uses leverage money to make loan, then the Basel Accord require the bank to hold capital against the loan. So this is the so-called the method to make sure that the bank behave, when they make loan, because if they don't, meaning that if they are negligent or if they are, deliberately wanting to take advantage of the leverage system, they will make the loan to their families, to their business partner, and eventually this loan will get into default. So that is why the Basel Accord require bank to hold enough capital against all loans funded by leverage money. So what we can see here is that leverage funding will lead to the making of interest-bearing loan with risk control through collaterals and guarantees. So meaning that when the bank observe the risk management process, meaning that they have to identify the risk, measure the risk, and to mitigate the risk, then it will imply that the bank is able to control the amount of risk in the loan through the system of collateral and guarantees. So, for example, if the bank hold a loan supported with more collateral, then the bank faces less risk because any default will be covered by the collateral when the bank are able to sell off the collateral to recover the loan. So when a loan is supported with higher amount of collateral, then the bank faces less risk. Thus, the bank now will hold lower capital charges. Excuse me. Likewise, if the bank gave a loan with low collateral, with low guarantee, then the bank will face higher risk because if there's a default, there is less asset the bank can rely on to recover their money. So because of the higher risk faced by the bank, then they have to hold higher capital requirements. So this risk-taking activity is, excuse me, is essentially supported with the required capital as accorded by the Basel standard. Excuse me. So capital management is thus very, very important. It is very critical for banking. So any loan offered to borrower, the bank must hold enough capital against this loan. So it is not just making a loan to the borrower. The bank must make sure that they have enough capital to ensure that if this loan get into trouble, the bank have enough money to absorb these losses. So instead of using capital to make loan, now banking capital is used to support or to absorb any losses that is coming from default. So stress on capital emerges, when loss from default will result in the decline of capital, because with less capital, the bank is not able to back up new loans with capital, thus losing new business opportunities. As we know that banking capital, which is whose function is to absorb potential losses, but at the same time, it also implies that with a given amount of capital, then the bank will be able to issue a given amount of loan and thus, earning interest from this new loan. But if there is not enough capital for the bank to use to make new loan, because this capital is used to support risky loan with higher risk-weighted number, that resulted in the holding of more capital. So bank will not be able to make new loans because they lack the amount of capital to do so. So we can see that if the bank do not have enough capital to make new loans, they can raise capital to make new loans. But if they were to do that, then it would mean diluting bank ownership and control, and many banks would not want to do that. So they would like to essentially maintain the existing systems of collateral and guarantee to control the amount of risk that they are able to hold, for specific exposure. So in a sense that the system of collateral and guarantee, will reflect the risk appetite that the bank is currently holding, to highlight, the kind of risk that the bank is willing to take. So if the bank intend to use a bank contract, which is by nature is highly risky, because albeit contract under the system of true sale, true lease, partnership, salam and istisna, they are by default very risky, as the outcome of albeit is influenced by market forces and not influenced by contract. So it will put stress on banking capital if the bank plan to use albeit funded by leverage money or funded by deposit. So albeit contract under the system of true lease, as I say, true sale, partnership, salam and istisna, are by default exposed to business risk. That is risk arising from ownership, risk arising from price volatility, and risk arising from the keeping of inventory. So these are ownership risk, price risk, and inventory risk that are by default existing in all albeit contract. So when the Islamic bank that is driven by leverage money plans to apply albeit, then it will put severe capital stress on their banking business when they want to pursue the albeit transaction. This is because higher exposure to albeit contract will increase business risk and therefore capital charges. Albeit contract do not offer Islamic bank a guaranteed capital and profit like the riba loans. The profitability of albeit contract are unknown, as the outcome of business is determined by market forces and not by a contract of loan with riba. So we will get into more discussion of albeit, especially using one product under the system of murabaha by purchase order. I will see you again, guys. Thank you very much. Assalamualaikum warahmatullah.